Hi, and welcome to the Art of Technical Analysis, the Academy channel. And before I start, I want to state a disclaimer. This is not financial advice. This is pure educational purpose only. Well, good job on finishing level 1 and level 2. After having mastered those levels, you'll be able to analyze the markets yourself. You will not need the media or the news anymore. As most professional traders say, show me the markets, then I'll show you the news. Well, this is undeniable. However, today we're gonna talk about moving averages. Level 3 of the Art of Technical Analysis. This is also the most commonly used, one of the most commonly used methods. And before we begin, you need to be conscious of which time frame you are. As you can see on this chart, we are now on the daily, and this means these lines you can see here, they are the daily EMAs. And this time I've chosen the Fibonacci sequence. And what you need to know is that these are actually the price levels lagging behind the current price action. Well, how this exactly now works, I will not go into mathematically for you to save you to spare you the details. What you should know, I've chosen the settings of the Fibonacci sequence, what I already said. This means that this line, this red line, is the 21 EMA. The next one is the 34, and the next one is the 55 EMA, and the next one is the 89. You have probably recognized the sequence already. It's the Fibonacci sequence, and I simply like using this sequence because you know, the Fibonacci, the golden number, eventually is something that appears everywhere in nature, or in the universe actually. So moving on, we're gonna dive in deeper into that in the higher levels. All right, so of course I did not learn this by heart. I just know the sequence: 21, 34, and 31 plus 34 plus 21 makes 55. So we are counting the current sequence 34, adding up the previous sequence 21, and that equals 55, and so on. So now you know that. This is the way we use it. You can use it as support or resistance in this case. As you can see, it's been respecting this EMA, daily EMA 21 as resistance. But once it got broken through to the other EMAs, it went up, but it went down again once it before it was respecting this as support, the EMA, the daily EMA 89, before it broke down or broke through. That led to a pretty pretty quick downtrend, as you can see, and it kept this line as resistance until it went through, and then it went up again. So when are you supposed to read this? Well, that's why we use the candles here, the regular candles. You could actually also use the Fibonacci candles, but the point is, you want, as you can see here, this candle broke through this EMA 21 and closed above it. And even better news, the next candle, the day after, it closed above the 34 daily EMA. These are bullish signals. Look at that. This one also, and it continue its bullish continuation. Well, we can say pretty much the other way around. So once the price action has broken through this as support, this is the EMA 21, and it closed underneath it, even the next day, and the next day, and the next day, and so on, until it actually just crashed, or reverse bearish, apparently. So that's the first way of using moving averages. There's another way. You can also search for death crosses or golden crosses, and here you actually got perfect example of a golden cross. You can see the daily EMA 21 and 34 going up, having a bullish trend, and then crossing over each other. I mean that the 21 crosses over the 34. This is a perfect example of a golden cross. Here's a perfect example of a death cross. As you can see, the EMA 21 crosses under the EMA 34, leading into a bearish reversal, or actually a bearish continuation. As you can see, the price is dropping now. Well, those are the two ways of using moving averages. There are more ways, like you should also be cautious of where this thing. There's another factor where this you should know or look for if this crosses, like this thing crosses underneath the EMA 89 and 55. And here it crosses under but above the 55 and the 89. So as you can see here, it went up, crossing over other EMAs until you get this pattern. Purple, blue, green, and red from down to the top. But if you get this order, as you can see, it means it's probably going further up. You got a bullish continuation. But I don't like this. I don't use this because I'm like, this is far too late. I wanted here was a beautiful point to enter along or buy some bitcoins in this case. But even as an earlier signal would have been here when this candle closed above. That's why I use these two, because I think most traders are using these signals, right? I mean, you want to be ahead. You want to take as much as possible, you know, but be rational. Don't, I mean, it went up here, it still went down. So, although this could be an indication of that the downwards trend is cooling off, you know, preparing for a reversal. So that's pretty much moving averages. So and these are the most commonly used settings: the 20, 50, 100, and 200 when you use the standard sequence. And you've got the Fibonacci sequence: 21, 34, 55, and 89. So choose, for now, since you're a beginner, probably just use it on the daily and weekly chart. Well, that's pretty much it. Practice on other markets, of course. Always backtest this method, so you can build up some confidence, experience, and then you'll be able to make strategies. I've showed you how, the two ways now. So, well, you're pretty much an expert now at this level. So, if you're still interested, I'm gonna make more. The next level 4, and that's going to be about stochastic RSI, or the relative strength index. Something I want to talk about, since relative moving average is a formula that's being used in the RSI algorithm. Thus it would be a good lead to go move forward when we go to level 4 and talk about our RSI and how professional traders use this. Well, thanks for watching, and don't forget to like and subscribe. Leave a comment if you have any questions or whatsoever, and have a good day.